Welcome to Profiles in Risk. This is your host, Tony Cañas, and today we are recording episode, 216, I think. And I am here today with Colby Tunick, who is the CEO at Refocus AI. Colby, how's it going today?
It's going great. Thanks for having me on, Tony.
Awesome. Thank you for coming in. And we are recording on Black Friday. So Colby is a real trooper. Nobody else would have accepted an invite to record in the middle of the holiday weekend, but here we are. So Colby, tell me about Refocus AI. Right, when I hear the name, I'm thinking that you're applying artificial intelligence to reinsurance in some sort, or what is Refocus?
Sure. So Refocus AI is an enterprise machine learning platform to help insurance professionals make more sales. At a very high level, what we do is we use the data they already have, which in most situations is sufficient for machine learning applications to help them identify clients that are likely to do a specific action within a specific time period, whether that's purchase a new policy, whether that's have a claim, whether that's churn. And all of these insights are bound within a time frame. So today, this week, the next 2 weeks, this month. And what we're trying to do is get away from the model where just because we know the 10 policies an insurer doesn't have, we are now able to say, out of the 10 they don't have, this is the one they're going to purchase this week. So call them up about this. Or when they call in with a support question or a billing question, that's actually a sales opportunity and we should be treating it like one. And now we can say they're calling in with that question and you know they're likely to purchase something this week. And now you can work that into your conversation with them. And ultimately, this leads to making as much as 60% more sales without having to grow the amount of staff that an insurance agency or brokerage has.
Okay, so that was a lot. So let's start kind of digging into it. Okay, so the name of the company has AI in the name. Your description has enterprise machine learning. I am not a tech guy. I have a degree in management information systems, but I've never worked in it. So my understanding is that machine learning is a subsection of AI. Is that correct?
Yes. Yes.
Okay,
AI
is an
all-encompassing umbrella.
All-encompassing umbrella of machine learning, image recognition, natural language processing. What else falls into AI?
Deep learning. And then on the practical, everything you said, those are all things that fall under machine learning or AI. The machine learning is a subset. Machine learning is just the idea that if you give a computer algorithm, like you would give a statistician, certain data points, over time, it's able to recognize trends and then infer new ones. And yeah, so it's just, when we think about machine learning, for the last 300 years, we've had actuaries. Actuaries do the same job that machine learning now does, except machine learning can do it far more efficiently because you're looking at hundreds, if not thousands of data points across thousands of rows of data, where previously we're looking at 2 or 3 data points across those same customer segments. So with the more data you're able to look at with each individual attribute that you add into that model, and when I say model, I mean machine learning model, because fundamentally what it is, it's just a big computer algorithm. Just you could do it out by hand, but computers are able to do math faster than humans, and that's really where the innovation lies. And with each attribute you add in, it becomes more and more accurate, and then you can understand perhaps factors that you weren't aware of before. So one of the big questions in insurance has always been, why does having more policies make a customer more likely to stay with an agency or brokerage? And machine learning can provide answers into the correlation between why more policies equals higher retention for a customer.
Okay, this is interesting. So it's, for the whole time that I've been in insurance, about the last 10 years, it's been a truism that I remember back at Nationwide, the numbers that they gave us, and I was never an agent, I was always on the carrier side, but the numbers that they gave us was single line or one policy, the retention is about 70%. 2 policies with the same clients, the retention is like 90%. 3 policies is like 99%, right? And anything over 3, so that's why they give you such great discounts on packaging home and auto, and you put an umbrella on top of it or a business with it, and you're going to be a client for a long time, right? But I have never in 10 years in the industry, I have never heard the question why, right? It's just the data. Our data has found that this is true, so let's make sure we multi-line. Okay, so that's very. I found it really interesting that you talked about sales and you talked about timing, right? There are probably 300 insurtechs out there that are using AI in one way or another. Most of them carrier side. I haven't seen too many that are broker side or agency side. If I have an agency and I get your tool, I subscribe to your tool, right? We'll talk about how that works. Is the tool going to basically tell me when to call on my existing clients in order to cross-sell them or to white space or to offer them another line of coverage?
Exactly. And by being able to ground the likelihood of them to purchase an additional policy within a specific time frame, now your day as an agent or broker is spent that much more effectively, because every customer interaction you now have is a sales opportunity because you know what they're likely to do next, as well as when you are trying to grow your book in a specific direction, whether that be cross-sell from personal to commercial or personal life and health, or any way that you are growing your agency. With that context, you are now able to focus your time with either your current customers or with prospects that are most likely going to purchase a new line. So if you're doing that day in and day out, you can grow your business by as much as 60% rather than picking up the phone and just calling everybody in more of a scattershot approach.
That 60% number is pretty amazing, right? I think that most agencies would you would have the Fry's Futurama take my money meme for any tool that can offer me a 30% growth in sales. Tell me about that 60%. Is that what you guys have measured over the last year? How many agencies? What kind of agencies? Like, where does that number come from?
Yeah, so we have worked with a couple of our partner companies to understand their sales cycle and how they spend their day. And there's a couple of just, I guess, assumptions that we should talk about quickly. For every $1 million in premium that a company brings in, they normally have to have one agent or account executive to handle about that $1 million of premium. And when we think about growing a book, the great limiter in growing the book is how many sales staff you have, and that overhead grows quickly as you expand your business. So with a sales tool that allows you to identify who exactly is going to purchase something this month, you now no longer need as many insurance agents or brokers on the phone calling those leads or those current customers. And all of that leads to about up to a 60 times increase in revenue, because you're doing your job just that much more effectively. A question we get is, and some of the comments we've gotten, frankly, are, I'm already happy with the size of my book. I'm kind of just in maintenance mode. I'm no longer growing it.
That's the fact that anybody's honestly telling you that is very interesting. Many agencies are exactly there. They don't like to say it out loud. Anyway, continue.
Another one we get is, I've sold this way for 20 years. I've been my own agency now for that period of time. Why do I need another tool when clearly I know how to sell? And the answer to that is quite simple. To all of those situations, there are opportunities that you are missing. And machine learning and software in insurance, what it's doing is it's helping you capture the revenue you're leaving on the table and helping you spend your time more efficiently. And all of that then contributes to that 60% increase. And there's a lot of people out there that are okay with the size of the book they have now. And that's, they built their book 30 years ago and it's done well since. They've been able to maintain it. There's been of course, there's normal churn. Churn averages about 5% a year, but they're able to bring on new policyholders to kind of offset that in their brokerage or agency. But for people that are looking to grow their book and looking to grow their book without having to hire more staff, with wanting to spend their time more effectively, using the next generation of insurance technology to do that, and ultimately to build a better mousetrap, is where we help our partners.
Well, I'll tell you what. While many agents are sitting on stable books, one thing that they all seem to struggle with, or the great majority of them seem to struggle with, and the reason that they reach out to me, especially on my day job side with Jacobson, is, and the funny thing is we can't help them with this. We can't help with just about anything else when it comes to staffing. But the biggest problem that they tend to call with is I can't find good new producers, right? Good young producers to build to help me grow the agency, and they seem to have this problem of they hire people either who come from insurance or have the right personality, good enough golfers, and basically hand them a phone book and say good luck. And of course, the people end up not being successful. How would having this tool, this service, how would it help me when I bring in a new producer?
Absolutely. Excuse me. So I think there was kind of an assumption in what you said, and the fact, and let me know if I don't articulate it correctly. It's just the way that someone would grow a book 30 years ago no longer applies. I used a phone book analogy, and I think for anyone that's ever had a sales job in the last 10 years, picking up and just calling everyone in their family is no longer an effective way to sell. And that can be a bit of a generational disconnect between between the agency owner and that recent college grad they just brought in.
I actually I want to add some color commentary. I read this book specifically for what I do in my day job, because I do a version of this of selling staffing, but I do a very high level. I'm selling high level staff specifically to insurance. But basically, this guy actually did the research, and just 10 years ago, I believe, just like 10, 15 years ago, when your boss is likely to have built his book, 1 in every 6 phone calls actually connected to the person that you were calling. Today, that is 1 in every 23.
Wow.
So that is a radical change. So yeah, just dialing for dollars or smile and dial is that much less effective.
Yeah, and to the original question is, how does new technology, how does Refocus AI help a company with younger producers? It's because what we're trying to get away from ultimately is the knowledge, the lack of knowledge in these new insurance professionals. And it's one thing to be able to say, I've been in insurance for 20 years, so I know how I should approach this person, or because I've known them for 15 years, I know that they're about to reach retirement age and they'll need Medicare, just all of these life lessons that come with being in an industry for so long. And if we can take that, if we can kind of remove just a little bit of that, and in the place of it, put the data you already have in your book of business. So now that young producer out of college who is trying to connect with 1 in 23 people, which is quite a high number. I know that that would probably average about what we do internally, maybe 1 in 15 if they're warm. But now when you pick up the phone to call somebody, that they actually need what you're trying to sell them. So some of the people that we've spoken with that have used our product have talked about it like they had a crystal ball and the customer was surprised because it was top of mind for the customer when they called. And the conversation went something like this: oh, I was actually just about to call you about this. Yes, of course I want to get, insert policy X or policy Y, or, I wanted to grow my coverage. I no longer want the minimum umbrella or the minimum life insurance amount because now, these factors, I need more coverage. So it's both a cross-sell and an upsell opportunity.
Are you focused on commercial lines, personal lines, both? Which types of books does this work with?
So it works for all books. We've been primarily focused though on commercial mid-market P&C. And the reason for that is very simple. 80% of investment in insurance technology has gone into personal lines. A lot of that investment has gone to companies like Hippo, like Lemonade. I'm sure everyone can Metro Mile, all of the, easy consumer, kind of have one risk model for everybody. But on the commercial side of business, and if you get beyond the P&C side, but you get to health, you get to complex or specialty type of policies, there's really not a tool set for agents in that space. The interesting thing is, though, if you were to slice the insurance market up, 53% of all the premium every year goes to personal lines. Put another way, half of the premium every year goes to commercial policies. So with 80% of the investment being on the commercial or the personal side, that leaves a gaping need for the same sort of tool set and technology on the commercial side, which is why we focus there. But the product doesn't care. As long as the agent has a book of business, they can use our product in conjunction with it to identify sales opportunities in real time. One of the, I guess, truisms, another truism is 80% of your sales comes from 20% of your existing customers. And the reason for that is quite simple. It's because there's always money left on the table. That you can always, identify new opportunities that can help grow your business. And for agencies with an existing customer base, Refocus helps them identify those customers who need more coverage or different coverage or additional coverage. But the product also works with prospects. We have a lot of people who go out and they'll buy 1,000 names. And I'll put a little asterisk here. Just having someone's name and a phone number isn't enough for a machine learning solution, any machine learning solution. But if you have 10 or 15 bits of data on that customer, where do they live, what city, how old they are, things of that nature, at that point you can start qualifying prospects so who is it actually worth for you reaching out to. But our product helps people with a personal lines book, growing their commercial book, for personal agents trying to grow into the life and health section. We have a couple of commercial companies who are pursuing new policy types, like cyber. So they haven't had a cyber book before, but now they're trying to sell cyber to their existing customers. And knowing which customers are likely to purchase that this week is very important for them in order to continue to work with the carriers that have appointed them.
So you keep saying this week, and I'm having a very hard time getting my head around the idea of this week. So you're telling me that as long as I have a big enough book of business, and I do want you to let me know how big a big enough book of business is, and I plug you into my agency management system, the system can tell me with some level of certainty that the ones that are likely to be buying insurance from me or for somebody else this week. So how the heck does it know the timing to the level of a specific week?
Absolutely. So the first premise is the system needs at least 5,000 policies or policy holders with, however many policy total that is for those 5,000. But at least 5,000 points of data to start. Most of the companies we work with have currently 50,000 policy holders and a huge historical database as well. We don't need that many. But for those companies, we're actually able to provide daily or weekly insights. For companies that have a smaller book of business, 5,000 to around 20,000, we're able to give them biweekly or monthly insights. So this month, what is your customer likely to purchase? Or, in this next 2 weeks, the next 14 days, what is this person likely to purchase?
So when you say companies, that sounds more like carriers, especially with 50,000. So are you mostly at this point partnering with carriers than with brokers?
Broker and wholesales are, where we hang our hat the most. The reason I say companies is because we're in commercial P&C primarily for our partners. But if you were to put it in personal lines, you would say my insurer this week is going to need X, Y, and Z. The way it works is when you look at a book of business, it's so much more than just the basic, personable, identifiable information for that policyholder. You have everything that's on an Accord form, you have everything that's on a carrier form, you have everything that's on a supplemental. So for each person, you're looking at sometimes in excess of 200 unique points of data. And when you look at 200 unique points of data across thousands, 5, 20, 50,000 policyholders, you're able to start inferring. Some people would say predicting, but what machine learning does is it infers. It's a little bit of technical language in the field. we can infer what that person is going to do next and a specific time frame. And that's because we're able to look at everyone else that you've already sold to, and we build the machine learning algorithm builds a unique profile for each person. And then based on everyone else in your book of business, this is what they're likely to do next. But the reason that's important is twofold. One, every single agency or brokerage is unique, and you can't treat them like one, general uniform entity, because everyone has a unique marketplace, a unique geographic zone, a unique type of policies they focus on. And two, because market conditions change so rapidly, you need to be constantly updating these inferences so that you know what they're going to do next. And that's why we ground each one in a specific time period. You asked how accurate they are. You rank machine learning models in a percent of accuracy, meaning if I say with 90% accuracy, this means that this is pretty much going to happen. Our models have, or our platform is between 90 and 97% accurate. So when we say that Tony is going to purchase this policy next week, we're saying that with 90% certainty that you are actually going to purchase that policy. This technology can be applied to, if you want to get outside of insurance and, take your insurance hat off, your likelihood to get COVID, your likelihood to get married, the likelihood that you'll graduate with a specific degree from a specific university, so on and so forth.
I want to take it a little bit outside of insurance into staffing, which is what I do. I would love to know which prospects or clients to call this week. Who is likely to need a temporary actuary or underwriter or accountant this week? That would be amazing on my side of the business. You mentioned that before we started recording, you mentioned that you get a lot of questions about the pandemic, about climate change, and about the reinsurance market. I haven't found a place to stick those, so let's just jump right into them. How are those things, and I know that those are three really broad categories, how are they affecting your side of the industry?
Sure. So they're all interrelated in the fact that risk is getting harder and harder to write, especially on commercial side, because you're not just talking about what is the likelihood of a 25-year-old male getting into an auto accident in California. You're now getting way outside of that, and you're saying, what's the likelihood that this business in Houston is going to get flooded or burned down, directly hit by a hurricane? So kind of taking a wide view out. Climate change, it's real, it's happening. This is the first year, or the first time since 2005, I believe was the year, that we ran out of names for hurricanes or for tropical storms. Now we're in the Greek alphabet, and they're about to run out of names for those. And we know that with sea level rise, we know that with worsening weather conditions, complex risks can get harder to write because it's going to be more unpredictable. And humans have chosen to settle in places that are not beneficial to these sort of worsening ecological, environmental conditions. A lot of the places where our partner companies or the industry insures individuals or organizations are in areas that are extremely risk prone. And we want to help both our companies, but as well as the policyholders that they have the coverage they need. So I live in San Diego, California, and we're big on earthquakes in California. A lot of people don't realize that an earthquake in California is explicitly excluded from their homeowners or renters. And a lot of the agents we've spoken with in California choose not to offer earthquake insurance as a supplemental coverage because they just don't see there being enough money in it for them. And that's quite unfortunate, because when we think about insurance, it's often the key financial instrument that communities and community people who live in the community use to rebuild their lives after a major natural catastrophe. And so an insurance agent or broker not offering their insured a coverage because they don't think there's enough commission in it for them is rather unfortunate. So a product like ours can help them say, out of the 1,000 people in the zip code with homeowners insurance, here are the 100 you should call today because they're likely to buy earthquake insurance. And if you do that enough, now you've built a supplemental line of coverage that's actually a huge part of your annual revenue. And that's one of the key pieces when it comes to climate change. Climate change is now affecting the reinsurance market. 2018 was a very difficult year for the reinsurance market. A lot of companies had to call upon their reinsurers. They exist for a reason. They're an important part of the flow of money in the insurance ecosystem. But when reinsurers raise their rates, we get what we see today, which is a hardening market. And that means that policies take longer to write, they're harder to place, and they're more expensive. So that also means that there's going to be churn among, perhaps higher churn than normal among the policyholders that an agency or brokerage has, because they're going to go out and maybe choose to be more price sensitive than they have been historically. And then this is where the pandemic comes in. My co-founder, Elijah Chang, I have my CTO, Alexander Pearson Goulart, they're always, they're key parts of the team, even though they're not on this call. They were doing some research and they found that for a company, for a corporation, they'll spend 20 to 30% of their gross revenue on insurance. So if we just kind of put that in perspective, up to 30%, but average between 20 and 30%. So if they're losing 50% of their revenue because of COVID, because of other natural catastrophes, which means they can't stay open and make revenue, they have to look for cuts somewhere. A normal place to look for cuts is insurance. Perhaps you don't get the same amount of coverage that you have had historically. Perhaps you drop certain coverages that you might consider more optional, with the hopes that come more prosperous years, you can then re-add those on when the business is doing well again. So all of these, the three you mentioned, climate change, COVID, and reinsurance, and of course we could probably spend a podcast on each one of those. They're making it harder for insurance agents and brokers to grow their business. They're making it harder for wholesalers who are trying to qualify, all the leads they're getting from agents and brokers and then match them to the market. And then carriers are trying to say, what the heck is going on? Are we gonna, are we meeting our reserve thresholds with everything that's going on? Using machine learning to answer those key questions in real time is really important to be able to grow your business sustainably. I will say though, Tony, that we're not a machine learning software for data scientists or actuaries. We're a machine learning software for you, the business professional, the insurance professional. We have reduced all of the machine learning down to just a couple of key clicks that anyone can understand. And that's just a really important thing to mention, because ultimately, most people want data scientists. They know they're valuable, but they just can't afford them. So we cater to a different audience, and that being you, the person who is trying to grow a staffing company. The insurance professional is trying to grow a new book of business or a different line of insurance.
So it's a turnkey solution.
Exactly.
What does the revenue model look like? Is it a monthly subscription? Is it based on the size of my agency? How does that work?
Yeah, so we have a price point for retail agencies and brokerages, and then we have a price point for wholesalers and carriers. Wholesalers and carriers need just a little bit more. They have some unique cases, so they're a little bit more expensive. But for an average, retail shop, regardless of how many employees are there, it's a yearly subscription of $1,000, and then a small one-time implementation cost. And that's, I should say, $1,000 per person. And that's not normally everybody at the agency, but that could be that's the people that are selling. That's not your back office staff that are doing the filing. It's your brokers, it's your account managers, it's your producers. And we're so confident that the product works as advertised, as intended, that we will pay back our clients if it doesn't at least pay for itself within that year.
Is that guarantee only for the first year that they're a customer?
Well, I imagine that if our software didn't deliver within the first year, they wouldn't be a customer after that.
Okay, that is impressive. I haven't heard anybody else make that kind of claim. So that is pretty fantastic. And I think $1,000 per user. I'm not on the agent side, so it's hard for me to judge it. But if the reality is, each producer and each account manager probably cost me with benefits at least $100,000,
Mm-hmm.
right? On the low end, at least $100,000. So a 1% increase on that $100,000 for a guaranteed 60% increase on production there'll be pretty simple math right there, right? Like I'm tempted to to I'm getting better at video editing. I'm tempted to put the chart comparing those two numbers. Yeah, so that's off an offering. So that's pretty awesome. And you guys have only been around for about the last year, right?
A little over a year now.
A little over a year.
We started 5 months before COVID, and that was an interesting time period to be around for, trying to do a startup.
No kidding. So I think you've made a great case for Refocus. I always like to look at the career aspect, at how you got to where you are.
Yeah.
Because that's where we came from as insurance nerds. That was our origins. We're helping people with their careers. You've got an interesting background. So you went to school in Israel, not unusual for an Insurtech founder. There seems to be many. And then let's see, you came back to the States. You came to the States, and at some point you worked for a congressman as an internship. So that's interesting. Then let's start from there. So how did you end up interning for a Congress, and why didn't you pursue the politics side further?
So my background is in global affairs, and specifically that's what I studied at university as well as in Israel. One of my graduation requirements was to do an internship, and I actually far exceeded the requirements. I worked with a congressman here in Southern California for a year, almost exactly. And one of the things you realize is that if you really want to make a change, sometimes it's better to try to do that from the private sector. Working for the congressman was a great experience. I have nothing but great things to say about that office, about my time there. But it just reinforced to me how difficult it is for governments to adequately respond in the face of natural catastrophe. And I spent a lot of time looking at natural catastrophes, both environmental and human-made. And I really wanted to help people in a more meaningful way. And I think that's one of the places where insurance shines, right? It's the conversation you don't want to have, but you're happy you have insurance when you need it, right?
Mm-hmm, absolutely. Okay, so from there, you end up at Voyager Space Technologies. That seems like that is such a weird move from having interned at a Congress office, at a congressman's office. So what's Voyager Space? What were you doing for them?
Yeah, I did business development. Unfortunately, Voyager's
a polite word for sales.
Yes. Business development. Voyager was trying to shrink the satellite design process from 5 to 10 years down to about 3 months.
Oh, wow. Okay.
So a lot of people don't realize that to design a satellite, it takes about 5 to 10 years. It's entirely manual. And there's actually a lot of parallels between satellite design and insurance, funny enough.
Okay. You just unknowingly signed up to write an Insurance Nerd article about that particular comparison.
I would be happy to. Yeah. Well, I don't want to give away my article, but there's kind of two key pieces. When you think of insurance, right, it doesn't sound like it has anything to do with space. Space is shiny, it's new, it's exciting. We have reusable rockets. You know, it's kind of the sum of human ambition to go and colonize other planets, but they do it with technology that's pretty outdated. Oftentimes, they design satellites worth $350 million on Excel spreadsheets, and I guess the technology tool set that's there for someone who's designing satellites is practically comparable with someone who's trying to grow a book of business. So there's quite a few parallels there. There's more, not to give them away, but those are two. So at the same time I was working at Voyager Space Technologies, I was also working as a defense consultant and researcher at a company called DME Business Solutions. And working there, I was primarily doing research and writing grants, as well as supporting my project manager on defense projects all around the world. And so there was kind of a tie-in between space and defense and sales and what I was doing on the private consulting side. But either way, again, you have the goal of mine was to help people, was to deal in cutting edge technology, was to make life better. So after college, that's when I went and worked for the defense consultant. And then during that time, I also started doing sales, as you said, for the space technology startup.
So you're doing all that, and the next step here we go into insurance. You go into the CEA, and for those of you who are not from California, CEA is the California Earthquake Authority, which, if I'm not mistaken, is a government entity of the state of California, offering earthquake insurance in a, how do I put it? I can't think of the word. In a non, I can't think of the word right now. Basically, it has a huge deductible, and it doesn't quite bring you to being whole again. How do I, that feels okay. Anyway, so what were you doing at CEA?
Sure. So and I would encourage everyone to look at some of the new policy options that the Earthquake Authority has rolled out with. It's definitely come a long ways. There's a lot of misconceptions around deductibles too when it comes to earthquake insurance, and I know the CA has a couple of great resources on their website around that. So it's not nearly as incomplete or as uncovered as one might think now. But I encourage everyone to go ahead and take a look at those resources. But working at the Earthquake Authority, I was handling professional development. I was their training coordinator. And people often ask, what does professional development have to do with machine learning? And it's actually quite a simple answer. When you work in professional development, it's your job to know extremely well every single person's job and what they need help with. And while I was there, I began to work with people on our business intelligence team, as well as just had an opportunity to speak with everyone that was handling the data side of the house, and realized that like other insurance carriers, there's almost a paralyzing amount of data that insurance companies have to deal with. Insurance is one of the few industries that one can make an accurate claim that they have too much data. And they have both current policyholder data as well as legacy data. And then you get into, what do you do with this data? How do you use this data to drive business decisions? And for the CEA being a government entity, it's a not-for-profit, but for for-profit insurance companies, how do I use this data to make more sales? And one of the things we know in insurance is that acquiring a new customer is extremely expensive. On the personal line side, this is between $800 and $1,200 in advertising costs. And on the commercial side, it's upwards of $2,000 per customer you bring on. And trying to use your data to reduce those costs, to be more effective, to outreach, to send key campaigns to people that are likely to purchase something within a specific time frame, all of those key questions at scale become more important to answer. And so from there, we realized there was an opportunity. I put together a team with my two co-founders. We have a machine learning engineer as well, Vatsala Garwal, who's just a real champion when it comes to everything around machine learning, which is very much an art as well as a science. And we struck out on our own. Over the last year, we've had the privilege of speaking with hundreds and hundreds of insurance executives, and just had the opportunity to pick their brains and see, what was keeping them up at night, where were their hair on fire moments. And they all came back and said, we don't know if we can use our data for anything, but ultimately what we need to do is grow our market share. And so out of that came Refocus. And then in September of this year, we launched our first product to the market, and that has been exciting.
This is a great example, career-wise, on how there is no defined path for an insurance professional and for an Insurtech founder. So I really, really like that. So for the listeners, those of you in a decision-making role within a carrier, broker, wholesaler, this looks like a great product. And for those of you here listening for the career side, biggest lesson I want you to take is you literally had one job with insurance as a trainer, right? That's like a sliver of insurance experience, and you identified an actual problem, right? My favorite Insurtechs and the ones that I think will be successful are exactly the ones that identified a problem within insurance and then found a tech co-founder and funding to get it off the ground, rather than the many who are a fun tech toy looking for a problem, right?
Yeah.
So I think that's super cool, basically. And I look forward to see what you guys do. So did you guys go through an accelerator?
We went through a couple of, I guess you could call them incubators.
Incubators, yeah.
We were a little early for a couple of the accelerators we were speaking with, so we hope to get in, this coming year. It was also just a hard year because a lot of accelerators changed their focus, and some of them changed their focus to be more banking and less insurance technology. So insurance is a very specific subset of financial technology.
Mm-hmm. Yeah.
And a lot of companies that have been funding, some of these accelerators said, actually, we're no longer interested in putting money into insurance technology because that's kind of a for lack of a better word, a mess on the corporate funding side. So let's put money into banking, companies like Stripe, companies like Plaid that are, connecting the ecosystem.
So going back to fintech.
Let's go back to more of a pure fintech play. And then we also had companies or accelerators that said, we want to go and we want to hedge long-term bets. So we no longer want to fund companies or, accelerate companies that are using well-defined technology to solve a key business area. We want to be funding companies that are developing the next version, the future of this technology. And so, we're no longer going from like 3 to 6 years from start to exit. We're going like 10 to 15 years. Like they're developing.
What? That's crazy for the venture world. That's crazy. Interesting. Okay, so you guys are at the point where this is your full-time job for at least for you, right? And you're at the point where you can the technology works, and you're onboarding clients. So what do you what's left to be built?
Absolutely. So we just rolled out with a new model, a new algorithm, if you will, and we can always roll out with more algorithms. And what we want to try to do is become more and more precise in what we're telling you. So right now we can tell you, Tony, this week these are the top 5 policies that Tony are likely to purchase ranked. Like, don't try to sell him these down here, try to sell him the one at the top. But in the future, we want to be able to say, okay, in addition to that, what is the date Tony's going to leave your agency? What date do we think he's going to have a claim? How many policies is he likely to ever have with you? Because ultimately, you don't really care. I mean, you care about the people that have a single policy, but those aren't the people you're interested in. You're interested.
You can't long-term run an agency on monolined clients.
So to know before you choose to work with someone, what is their likelihood of having more than one policy? And we can tell you, exactly the amount of policies that we think someone will have. Colby's going to have 3 policies. Here's the ones that we think they're going to be. And you can then make the decision before you even work with someone if that's going to be profitable for your business. We also are just continually rolling out, user interface improvements. We're working on back-end technology to make onboarding easier. So because we sit on top of the agency management system or CRM, or just the database that a company has, there's always more work to be done to streamline that. So we're rolling out new integrations with direct integrations with agency management systems. And all of those things just take development time.
Okay, got it. Thank you. Well, it's been great. The tool sounds pretty cool, for sure. So I definitely want to encourage the listeners to give you a call if a 60% increase. I can't get myself to say it. Like it's hard to even say it. If a 60% increase on the efficiency of your salespeople and your cross-sale people would be a nice thing to have in your agency, brokerage, or wholesaler.
If you want
give them a call. I will tag you on I will tag your LinkedIn on the podcast when I release it, and I will tag the company. Great chatting with you today. Thank you for making time in the middle of a holiday weekend. No rest for the wicked. And thank you very much.
Thanks, Tony.